Hi, welcome back to AIA Uncut. In the last episode, we talked about how AI analysis started and why we decided to build real solutions instead of playing the same broken game. Today, we're going deeper into one of the biggest problems in crypto, token launches and exchanges, and why most projects fail before they even get a real chance. To understand that, we need to start with the basics. First, what is an exchange? A centralized exchange is what most people are familiar with. These are platforms where a company controls the infrastructure, the listings, the order books, and custody. Think speed, liquidity, and ease of use, but also full control by the exchange. A decentralized exchange is different. There's no central authority. Trades happen peer-to-peer through smart contracts. You keep custody of your funds, but liquidity, user experience, and protection can be very inconsistent. Both have their place. The problem isn't centralized or decentralized. The problem is how token listings are handled. Here's how a typical token launch usually works. A project pays a centralized exchange anywhere from $50,000 to several million dollars just to get listed. On top of that, exchanges often charge additional fees for marketing, featured placements, launch announcements, trading competitions, market making, and other so-called visibility packages. Then comes the real kicker. The exchange also asks for a large allocation of the project's tokens as part of the listing agreement. In most cases, those tokens are fully unlocked from day one. Now think about it logically. If you're an exchange, you've received tokens at little to no cost. The project launches, hype kicks in, and the price goes up. Why wouldn't you sell? Anyone would. And that's exactly what happens. As soon as trading opens, those tokens get dumped into the market, creating massive selling pressure. Prices crash, early investors panic, and the project gets labeled as a rug pull, even when the team did everything right. Most of the time, it wasn't even the team. There's another major risk almost nobody talks about, and that's market makers. To get liquidity on launch, projects are often required to allocate a large number of tokens to third-party market makers. These market makers are supposed to manage spreads, provide depth, and stabilize price action. But in reality, this is one of the most exposed parts of any token launch. Those tokens are usually unlocked. They're actively traded. And unless strict controls are in place, market makers can apply selling pressure, trade against momentum, or exit positions entirely, all while technically doing their job. From the outside, it looks like the project is dumping, when in reality, it's liquidity operations gone wrong or unchecked behavior. This is a complex topic, and it's one of the biggest failure points in token launches today. We actually have a full dedicated breakdown coming soon on market makers, how manipulation happens, and how we structure strict limits and controls to prevent it. So make sure you're watching for that episode. Now, some people will say, fine, centralized exchanges are the problem. Just launch on a decentralized exchange. So let's talk about DEX listings. On a decentralized exchange, there's no formal listing process. Anyone can create a liquidity pool and start trading. That sounds great in theory. But here's the reality. On a DEX, the project itself usually has to provide the liquidity. That means locking up a large amount of tokens and capital just to get trading started. If liquidity is too low, price swings are violent. If liquidity is too high without demand, the price slowly bleeds. There's also no built-in protection, no vesting enforcement, no safeguards against early insider selling, no structured launch process. If someone decides to dump, they can dump instantly. And because everything is permissionless, scammers and bad actors can exploit the system just as easily as real builders. Market makers on DEXs introduce another layer of difficulty. On decentralized exchanges, liquidity is often managed either by the project itself or by external parties using automated strategies. But because everything is permissionless, there are very limited ways to restrict behavior. You can't easily enforce inventory limits, prevent coordinated dumping, or stop whales from exploiting thin liquidity. If a market maker, a large holder, or an insider decides to exit aggressively, there are no circuit breakers, no oversight, and no enforcement layer. Smart contracts will execute exactly as instructed, even if the outcome destroys the chart. That's not malicious. That's just how permissionless systems work. This is one of the main reasons we are extremely cautious with DEX first launches. Without structure, controls, and active governance, it becomes almost impossible to manage manipulation, whale behavior, or liquidity abuse in real time. So while DEX are powerful and essential to crypto, launching a token there without structure, controls, or guidance often leads to the same result: extreme volatility, broken charts, and lost trust. So again, the issue isn't centralized or decentralized. The issue is structure. We experience this firsthand. And that's when we realize the system itself is broken. So when we built the AIA exchange, we decided to redesign the entire launch process from the ground up. We don't just list tokens. We work with projects from the very beginning. We start by understanding the project, the use case, the audience, and what the token is actually meant to do. Then we help design the tokenomics properly: supply, distribution, utility, and incentives that make sense long-term, not just for launch day. We also help build the token's technical infrastructure so it's suited to the project and its users, not a generic template. Once that's in place, we work closely with the project to design a pre-sale strategy, not hype-driven, structured, transparent, and built to protect both the project and the investors. Here's where we do things very differently. Every single pre-sale participant, founders, team members, advisors, and early contributors are locked in using time locks, price action mechanisms, and structured vesting schedules. That means no one can dump on launch, no shortcuts, no special treatment. When the pre-sale concludes, the final pre-sale price becomes the token's floor price. At that point, there is buying pressure, but no selling pressure. Then, and only then, the token is opened up to the wider community for public trading. Even if all tokens are traded freely after that, the price naturally stabilizes back at the floor rather than collapsing below it. This dramatically reduces pump and dump behavior and protects investor and community funds as much as realistically possible. Now let's be clear, crypto is still volatile. Nothing is risk-free. Prices can move unpredictably. But what we do is remove the unnecessary risk, the manipulation, the unfair advantages. We give projects a real chance to succeed and communities a fair environment to participate. That's what the AIA Exchange Launchpad is built for. Not quick flips, not hype cycles. It's designed for real projects, real structure, and real accountability. And here's something no other exchange does. If we genuinely believe in a project, not just the token, but the vision, the team, and the long-term execution, we don't stop at launching it. We partner with it. That can mean financial incentives, strategic support, infrastructure resources, or long-term alignment across the ecosystem. We're not interested in extracting value from projects. We're interested in helping them succeed. That's why, before any launch, we work closely with teams through a full consultation process. We help them pressure, test their idea, refine their tokenomics, structure their vesting, and design a launch strategy that actually makes sense. And this consultation isn't gated. We offer free advisory sessions to any serious project or business looking to tokenize assets, launch a token, or build crypto and payment infrastructure. No contracts, no hidden conditions, no obligation to launch with us. Whether they move forward or not, that's fine. Our goal is to share what we've learned, help builders avoid common mistakes, and raise the overall standard of how projects launch in crypto. That's the difference. Most exchanges sell listings. We build relationships. And when projects succeed long-term, the ecosystem succeeds with them. And as more projects come through our ecosystem, this becomes the standard we believe crypto should have had from the beginning. If you want to see how token launches should actually be done, with structure, fairness, and accountability, this is it. And that's all for this episode. If you found this valuable, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next breakdown. We'll see you in the next one.